Corporate finance practice problem using OneNote. Acquisition in 2 steps. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, the Practice Problems tab, down in the 2018 Acquisition in 2 Steps tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we got our information up top, calculations on the right. We're looking at an acquisition type of situation, one company thinking of acquiring another company, and we have a setup comparing and contrasting a two-step type of purchase process versus a one-step purchase process. Remember that there could be many different kind of ways that this thing is going to be structured, and it can get somewhat complex. Notice that we do have a lot more detail and a lot more depth in these in a advanced financial accounting course. So if you want to look into this in more detail, take a look at the advanced financial accounting course. So we got A to buy B. B, the shares outstanding are 2,300,000. The stock price is going to be $43. Then we have step 1, the percent of shares to purchase in step 1 is going to be 57%, noting that anything over 51% would in essence give them the controlling interest. We have the payment per share is going to be 71, and then step 2, the second offer, convertible preferred stock. So they're going to offer convertible preferred stock, 753,000. The market value preferred stock percent over the common stock is 40%. In other words, second offer, we're going to have 753,000 preferred stock. The value of the stock is going to be 40% over the stock price. So then we're going to have the second option, or comparing this two-step option to a single-step option, where we have just simply the payout amount of the $64 per share. So comparing those two, we'll start off with the two-step option here. So we're looking at step 1, they're going to be purchasing 57% in step 1, having anything, once again, over 51 being a controlling interest. So if there's 2,300,000 shares outstanding, and we take 57% of that, 2,300,000 times 0.57, that'll give us our 1,311,000, 1,311,000, and then we're going to say that it's going to be 71 payment per share on it. So we'll take that and we'll say, all right, there's that times the 71. That would cost the 93,081,000. Then we're going to say in the second step, in step 2, we're going to have the common stock at 43, and we got this preferred stock we're going to issue, which we said was 40% over the common stock price. So we can calculate that a few different ways. We could take the 43 times the 0.4. That would be the amount over the premium plus the 43. That would give us the 60.2. Or we can take the 100% plus the 0.4, 40%. Let's do that one more time. Then we can take the 1 plus 0.4, 1.4 or 140% times the 43. That'll give us the 60.2. The 60.2 times the preferred stock that are going to be issued, at 753,000. So times the 753,000, and that's going to give us the 45,330,600. So then if we were to add those two steps together, that plus step 1, which was at the 93081,000, that's going to give us a total of the 138,411,600. If we compare that to the one-step process where they just simply offer the $64, the $64 being less than the step 171 for 57% of the shares, but then we also have this preferred stock offer. So let's match this out. We're going to say we've got the total shares, which is going to be the 2,300,000. If we just give a flat out rate of 64 per share, we're going to be taking then the 2,300,000 times 64. That's going to give us the 147,200,000. So that, of course, is greater than the two-step process. So you would think from the standpoint of the acquisitioning company, it might be better for the two-step process in this instance.